Well, Mr. Pat Abbey, here we are again. How are you?
Good. How are you?
Good. So I am very excited to have this conversation because we just wrapped up a theme about how to view your company as a financial asset, which you have teed up with. You are the intro of that theme. And as people are starting to get a feel for it, you and I are introducing these themes as we continue to go on. And right after someone starts thinking about their company as a financial asset, the next question is, well, how the heck do valuations work? And
What's it worth?
what's it worth? What does it matter? How do we grow value if we don't even know what the heck value is and how to track and measure it? And I want to start with this question.
I hope that's the question people are asking themselves. That would be a very good sign.
That's progress, right? That's progress.
Progress.
So, you and I both get this question a lot, which is, it's not necessarily a question, it's a statement that I think you and I and our mission at Arkona is to just debunk. And it's the statement of, you know what, I'll never know what my company's worth till 10 years down the road when and how I decide to sell and someone's willing to write me a check. The only time I'll ever know what it's worth is when someone's willing to pay me a certain purchase price down the road. So I'm going to just say, what would your response be to that?
It's not true. I mean, that's not true. I know it seems daunting a little bit, but all kinds of companies do valuations, get valuations, on an ongoing basis for various reasons. ESOPs, companies that are ESOPs get a valuation every year. It's not because they're getting ready to sell or something's happening. That's just part of the law that they have to get a valuation so they can tell their participants in the ESOP what their shares are worth. And so it can be done. It's really important once you start thinking about your business as an asset to figure out where you are and where you want to go. I mean, you got to have all those pieces of information. It's how you always talk about Google Maps. You got to have a point A and a point B. Mm-hmm. Point A is, well, what is it worth today? And point B is, what is it worth at some point in the future, whether or not you're thinking about selling. You just want your asset to grow over the next 5 years. You have no intentions of selling it. So there's a way. We're not licensed valuation experts, but been through so many deals. I mean, and we understand it. There's a way to come up with a pretty good range of value for your company as it exists today.
And we're going to be unpacking the concepts. There's a few different concepts that we're going to unpack. I think it's close to 3 to 5 or something like that. These concepts to help people think about this as their ownership. And we're talking about the ownership role now of the equity and the asset. And, there's this, especially in today's marketplace, so much confusion of what really creates value. You look on the stock market or the public markets get all the attention because people can log in 24/7 and see the tickers going up and down. But then there's also this whole world of private equity. And you and I talk about these stats where there's a little over 3,900 public companies and 8,000 private equity backed companies that people can't log in and see a ticker symbol of how much they are worth, but they're doing the same thing. They're tracking and measuring how it's worth because you worked at a PE firm. Mm-hmm. So what is it that creates real value?
Cash flow. Sustainable, predictable, and transferable cash flow. When you buy a stock or you invest in a company or something, you're putting money down today that's worth based on the cash flows in anticipation of the cash flows that are coming in the future. I don't care if you're buying Apple stock or you're buying a company to own.
How about Peloton?
Well, we won't go there. But, and just one comment, the market's correcting itself for those companies who've never made money. That's a whole nother topic. But the value of a company is based on its cash flow in the future. And valuation experts go through all this exercise of discounting the future cash flows and all these other things. But what it's really worth is the cash flow that it can generate in the future. And the more sustainable, predictable, and transferable cash flow there is, the more it's worth.
Say it again.
Sustainable, predictable, and transferable. The more your cash flow are those 3 things, sustainable, predictable, and transferable, the more your company's worth. Because a buyer would say, that's a really good business model. They have sustainable, predictable, and transferable cash flow. So I'm going to pay more for it, as opposed to somebody who's thinking, that cash flow is really risky. I'm not sure it's going to show up after I own it. So I'm not going to pay very much for it. So understanding that is the first step in getting to the point where you can put a stake in the ground that says, okay, today my company's worth about X, and I want it to be Y in the future. And how do I get there?
And you and I, we've adopted this terminology just over the years from talking to owners of what really resonates is more sustainable, predictable, and transferable cash flow, de-risk the company. So maybe in your words, what does de-risking the company mean to you, and what does that do to the overall value of the company?
The cash flow of the company is affected by a lot of things, and it affects that sustainability, predictability, and transferability. And I think that the easiest way is to give an example. If you and I own companies in the same industry, same size, same revenue, same EBITDA, we'll get to that later, same cash flow. My company has 80% of its revenue coming from two customers, and your company has no customer with more than 5%,
Mm-hmm.
where the revenue is no more than one customer is no more than 5%. That alone says your company's worth more than mine, because if I lost one or two of my customers, 80% of my business would be gone.
Mm-hmm.
That's what we mean about risk of the cash flow. Is in my company, if every decision runs across my desk and I have to make every single decision and nobody can do anything on their own, and you've got a management team that's forward looking and strategic thinking and takes responsibility for their own things, and you can go off on vacation for a month, your company's worth more because the cash flow is more sustainable and predictable and
Mm-hmm.
transferable. So there are things that affect the risk of that cash flow that when you start to realize those things, you can address and say, how do I de-risk my company? How do I make decisions and implement strategies that will reduce the risk of the cash flow in the future for a company?
And you and I talk about this concept that I have tended to really enjoy because I think it helps me communicate the complex world of valuations into something that is easily understood of this intrinsic financial value versus the transaction value, strategic transaction value. Maybe you want to kind of give your definition of the intrinsic financial value, and then I'll take the transaction value,
Yeah.
because then we want to talk about how like what people can control and what they can do about it.
Yeah. So the intrinsic value is the value of your cash flows as they exist in your company today. Period. Not that you're got it on the market and listing it and your competitor wants to buy it. You're going to talk about that. If you were going to sell your business to me and I was just going to step into your owner's shoes, nothing else changed, what's the value of that cash flow? That's the intrinsic value. And valuations start there. No purpose to the deal or anything. It's just what is the value of that stream of cash flows into the future as they exist today in your company? That
So,
is the intrinsic value. And you can measure that. That's what ESOPs do. That's what all kinds of
mhm,
companies do, is just measure their intrinsic value. And even companies that are sold for what are called financial multiples, where
mhm.
it is just the ownership, like yours transferring to me, they would use the intrinsic value to determine that valuation.
And that's what we're going to continue to unpack for the most of this episode, because the next episode we're going to be talking to financial buyers to understand like how they're viewing that cash flow, and then the episode after that, the transaction value. But because today we want to talk about these concepts so people can understand them and then what to
Mhm.
do about them, and just to talk briefly about the strategic transaction value that again will be in the third episode of this series is. Like Pat said, there's a buyer and a seller that come together, and then there's the purpose of the deal. There's like two entities or two partners or two. There's a lot of human beings and emotions and strategies that go into play that someone could pay a premium, as Pat said. We're like, they synergies, back office, get into different geographic locations, product services. They pay a premium because they see the ability to get the return on investment. Someone might have a discount because it's a family business. They don't need the liquidity, and they're going to gift it to their kids through the estate plan. Point is, that's what gets talked about. And that's not something that you can plan on because you don't know
Right.
what that's going to be. And today we want to talk about what we can plan on and control. So that way we have more choices to vet out the different strategies later. So we're going to put that into the parking lot and then talk about the concepts and the terminology that people can view to find that point A that you're talking about, Pat. And so when you're talking about the measuring and monitoring and projecting out the value of your business, let's talk about like there's a couple different, there's only two numbers that are made up to get to the enterprise value. And we're going to get to that in a sec, but like, let's start talking about like, what should people understand to truly understand as it relates today, if they have a company, how do they start going about thinking about what that risk of that cash flow is today of the company that they own?
Well, yeah, and I'm not sure this is where you're going. The cash flow, though, do you want to talk about the risk of it, or defining the cash flow first? I
Honestly,
didn't
either way. Yeah, either way,
catch your
because
question.
either way is a good starting spot.
Yeah, so the cash flow in the valuation world is represented by what's called EBITDA, earnings before interest, taxes, depreciation, and amortization. It's what the investment world uses, and it's a proxy for cash flow. So there are a couple different ways of calculating cash flow, but that's what the investment world has settled on. You can take your financial statements, you take your net income, you add back non-cash items like depreciation and amortization, and you add back interest and taxes because you assume a debt-free situation with the company. And so that is
Can you
it is,
let me pause you for a second. Can you
yeah.
explain why that's important for the world of valuations and investors? Why getting to that proxy for free cash flow is so important?
Because it puts everybody on the same everybody's using the same definition of what it is they're talking about. When you go to sell your company, and if I think my EBITDA is $1 million and you think it's 500,000, chances are we're never going to get to a mutual transaction because we have just a different view of the world. EBITDA is a calculation. You or I or anybody could look at a set of financial statements that had a sufficient detail and come up with what's called reported EBITDA. It is just the mathematical calculation of starting with net income, adding those things back, and getting to EBITDA. So that it is a proxy for cash flow, and that's where it all starts. And every business owner should be looking at this all the time because
Hmm.
it's just easy to calculate, and it's the starting point for coming up with what your company might be worth.
So then let's in EBITDA, so a company, the enterprise value, and again, we'll get into enterprise and equity value in a little bit, but there's two numbers. There's the normalized or adjusted EBITDA times by a multiple that gets
Yeah,
to the value of the company. So that's why you said it's so important to get on the same page, because one of the two numbers that is multiplied on, you got to have agreement on both.
yeah.
So EBITDA is not one of those numbers. It's normalized or adjusted EBITDA. So you want to kind of expand on that, and then also why you shouldn't wait till the deal to be calculating that.
Right. So the first definition we talked about was what we call reported EBITDA. It's just the calculation right off the financial statements. Then you need to go through a process of what's called normalizing that EBITDA. And that is making adjustments to that reported EBITDA number to get to a revised or normalized EBITDA number, which is really the true view of the cash flow of the company that would exist if you weren't the owner. And some examples of adjustments to EBITDA, and you know this too from going through everything you've been through. For example, if you had somebody on the payroll who wasn't doing work, now we're not at all suggesting people take tax deductions for expenses where people aren't doing work, but just let's just say, for example, that was the case. Maybe that's not an expense that's normal in the business. That person's not doing the work, and so
Because if you were the owner and that was happening and I bought the company, I wouldn't have to do that to
you
keep the
wouldn't have to
machine
do that
going.
if my Uncle Billy was on the payroll, not doing anything, or I'm paying him and he spends 5 hours a week, but I'm paying him some outrageous amount of money, and I sold the company, that expense would go away. So we're adding that back. If you had in a particular year, you redesign your website, start to finish, and you spent $50,000. Well, it's not something you do every year. So you don't want to have that expense in there. You would add that back. These are unusual or one-time expenses or expenses that really don't belong as part of the cost structure of the company.
And you broke, like, I want to just kind of put a wrap around two parts of that, because you mentioned Uncle Billy, and I think a lot of times people think about that. They think about the cars or the tires or the different things that the owners call. I'm going to wrap it all into like owners perks. But then over here, you talk about the website. So
Yeah.
let's talk about owners perks that are the gray area or whatever. Like everybody kind of assumes. Kind of put that over there. maybe expand upon the website concept and why the website, maybe we can throw a couple other examples on why those would be also considered the same thing.
Yeah, because you're looking for a normalized EBITDA over a number of years. You want to look back 2 or 3 or 4 years, and if you have some big expenses, you have a website expenditure that you have, and you only have it every 5 or 7 years. You don't want to burden the year with that. If you engage with a recruiter to hire a top executive, and that rarely happens. It's the first
Mm-hmm.
time in your existence you've ever done that, and you spend $40,000 doing that. That's an add back. So those are unusual or one-time expenses, or ones that aren't really directly related to the cost structure of running the business. Those are ones you want to list and add back to EBITDA to get to normalized EBITDA. If you think about a sale at some point down the road, and you've got these expenses in your financial statements, in your income statement, you're going to want to tell the potential buyer, look, here's a whole bunch of expenses that aren't really germane to the business, and so we've added them back to get to normalized EBITDA. You're
Mm-hmm.
going to need to give them that list. They're not going to come to you and say, hey, why don't we add back $100,000 to EBITDA, just because you probably have some expenses in there that aren't legit. So it's really important. Plus, in running the business, you want to get a true picture of the cash flow.
Mm-hmm.
How
For
much is this
yourself.
business really generating, you know, as a business, excluding some of these unusual or one-time items?
And what I think that helps, and I've watched our clients or other business owners that run their company like assets, like we're talking about, Pat, is that normalization exercise on a monthly basis. First of all, you don't get to a sale and you have to go back 5 years and think about the story that you have to then recreate. And like, my God. But also is I watch people then, like the owners that we talk about, the normalization, that recruiter expense or that website, they have less cash that year, but they're investing in the company for
Uh-huh.
a reason. And on the last series, you and I talked about using a 3-statement model to project in the future. And it's like, hey, you can see that yourself, right? And so, like, I think,
Right.
I guess my point about bringing that up is, I think that a lot of owners, the stuff that sucks doing sometimes, like installing a new website or an ERP system, becomes more palatable when you know that there's a reason you're doing it.
Right. And you think, well, this is costing me, and I'm the accountant, so I like to watch the cost, but it's an investment in things. But it's important to do this, because if you want to know what's my company worth today, because I'm marching towards some future value at some point in the future, again, whether or not you're selling it, I just want this asset to grow.
Mm-hmm.
Getting to that normalized EBITDA number. I mean, you could literally have a company that shows zero net income that had a whole bunch of normalized EBITDA. So until
Yeah.
you get to that number, how do you have any idea what it is you're doing? And you can track them in the financial statements without getting too technical. You can have separate chart of account numbers that are like for these unusual one-time items. I literally do that with clients. And then in your financial statements, you can just add it back. It's not like you have to go through this big exercise every month. You can just it can happen very mechanically, and you can say, okay, my year to date, or my trailing 12 months, more importantly, my trailing 12 months EBITDA reported shows 600,000, but with the normalized EBITDA is 800,000.
Mm-hmm. And that's what we're going to time
That's
a
really
multiple by.
important. Pardon?
That's what we're going to times a multiple by. So like, I want
Yeah,
the 800,
yeah,
not the 500. And also, Pat, I watched, like, it's the narrative or how people discuss this that really starts to show the behavior change and how they're viewing their company. Because, like, I remember one of our clients a couple of years ago, like, I didn't do that well. And then they told me their net income. And then you go down to the normalized EBITDA, and normalized EBITDA that month was actually higher than the previous month.
yeah,
So it's like, you're just looking at the wrong number, because net
yeah.
income is not part of the valuation equation. It's the normalized
It's
EBITDA.
part of it, but it's the beginning of it. But yeah, you
Part of
can't.
the math equation. It's not the end result.
Yeah, it's not the end number. That's not the proxy for cash flow. I mean, it literally is not. I want to be careful too. There's some adjustments to EBITDA that can go the other way, that can
Mm-hmm.
subtract from reported EBITDA to get to normalized EBITDA. For example, if you owned your company and for whatever reason you were CEO and you paid yourself $40,000, but market it was 120,
Mm-hmm.
Well, that $80,000 a year is a negative. You got to add cost or subtract from your reported EBITDA, because if in a normal situation, if you weren't the owner, somebody would have to sit in that seat and be paid $120,000. So it's important to get these things right, without trying to skew it one way or the other, because the day you transition your ownership, and all ownership will transition in one day. Nobody lives forever, so it's going to transition at one day. A potential buyer is going to dig through this, and they're going to come to understand that. So it's you're just much better ahead. You're leveling the playing field by understanding this now as you go along.
And you're pulling on a concept that we talked about in the last theme, which is your job versus your ownership role, and then normalizing of your salary. So many people play games with that. I mean, I don't know how many people, but it's got to be a disproportionate percentage of the people play games one way or the other with the owner's salary. And you can't get a clear picture of what your
Right.
company's worth or what your income needs are without doing that. So again, you're just
Right.
lying to the only person that matters is yourself in this
Yeah.
situation.
It's taking a low salary and higher distributions or the other way around
Yep.
for whatever reason, which I don't advocate. You got to get to that true normalized EBITDA. That is that's the representation of cash flow of a business. And then you got to figure out how sustainable, predictable, and transferable do you think it is, in order to complete the valuation equation.
So then there's this multiple that normalized EBITDA is times by multiplied by. So people call it the multiple multiplier with all the different terminology, but it's essentially another number.
Multiple.
I
We're
know.
gonna straighten that out
I
today.
know.
It's
I know.
it's not multiplier. It's
So many
multiple.
people say multiplier. I'm like, what? Well, not a lot of math majors. All the entrepreneurs, they bailed out, and then
Yeah.
the multiple. So we're not going to get too granular into the weighted average cost of capital, but let's demystify a little bit of where the heck does that number come from and what is it representing?
So the multiple represents how risky somebody thinks your cash flow is. In our situation that we were describing before, almost like a case study, you and I had the same business, same industry, same revenue, same normalized to EBITDA, but I've got customer concentration problems. I've got a crappy management team. My financials aren't good, and all that kind of thing. And yours is just the opposite. You've got no customer concentration problem. You got a great management team, those kind of things. Somebody's going to be willing to pay more for your company than mine, because they're going to view your cash flow as more sustainable, predictable, and transferable. So the multiple represents the number of years of normalized EBITDA somebody's willing to pay you for your business.
I love it.
It could be a 5, for example, or a 7. So if somebody says, I'm going to pay you 5x, and that's kind of how people do it, say, and you have $1 million worth of normalized EBITDA, somebody's saying, I'm going to pay you $5 million for your business. From their point of view, if nothing changes about the business, they'll get their money back in 5 years.
And have an asset.
And have an asset. In the case, if they're buying mine, they're like, man, you got a lot of problems in your company, so we're only going to pay you a 3,
Mm-hmm.
because we're not sure that cash flow is going to show up, because of all the risk associated with what's going on in your company. So it has to do with risk, but in the valuation world, it's a number of years that somebody's willing to pay. Number of years of cash flow that somebody's willing to pay you for your business. When you're talking about intrinsic value, there's industry guidelines and standards, and valuation folks like your guests that are coming on the next couple of weeks. They have access to databases. They can say, okay, somebody in the automotive industry and this size, this location, this number of employees, go through some metrics. The multiple is between 4 and 6,
Mm-hmm.
just to give an example. So you can get access to that information and then use that, apply that to your normalized EBITDA on an ongoing basis, and understand what your company could be worth in a intrinsic value way.
And you said the perfect word. It's directional guidelines, right? Like this is not something you're going to transact on or buy out your partner on or anything. It's to know, is your company worth 2 million, 20 million? Like,
Yeah,
I mean, and to get some realistic expectations that it's not 20 times revenue because a SaaS company at the country club also said that, and you've got a
yeah,
dry cleaner. And I think
yeah.
just to speak on, and we can unpack a little bit of the kind of the guidelines, and because again, you don't need to get a $30,000 valuation to get these guidelines. You know, we talk, a lot of people talk about asset, they're the different industries, which private equity firms call asset classes, but we call them industries. I mean, it's just all the same thing, but a CPA firm has different risk than a e-commerce, different risk than a SaaS business, different risk than manufacturing and distribution. You want to speak to kind of like I don't know if you have a comment on that or just kind of just realizing that that's also inherently built into some of these multiples.
Oh, yeah. Different industries have different ranges of multiples. Size can matter. Typically, the bigger you are, the less risky the cash flow is. I mean, it's not always the case, but generally, geography, age of company, industry. If you were in California making plastic straws, your multiple is probably not going to be very high because of just the environment there. But you don't have to go through some gigantic exercise. A lot of people belong to industry trade groups. There's a lot of information available today that says, you know, um, what multiples might apply to certain size companies. Pepperdine, I think you've had one of the
Mm-hmm.
folks from Pepperdine
He does
University
a
who
private cap,
publishes.
yeah, private capital
Yeah,
market study or something like that.
yeah. They publish some things. We work with people, valuation companies, who will not kind of, they will come in and do a streamlined valuation. They'll look at your company, they'll take your financials, they'll do some modeling, have a management interview, and say, we think the multiples for your company are between 5 and 7, whatever it might be. So, and it's not super expensive. There are ways to get this information that you can then apply to your financials on an ongoing basis to watch the trend of the value of your company. It's really important to do today. It's really important to say, here's the stake in the ground today of my company might be worth between $3 and $4 million. I want it to, in 10 years, I want it to be worth, I don't know if the math's good, $8 or $9 million,
Mm-hmm.
whatever that might be. If you don't know where you are today, it's hard to know what to do to get to where you want to be at some point in the future. Again, whether or not you're selling. I know I've said that a lot, but this is not about waiting till you have somebody calling you want to buy your company, or you turn my age and you're like, okay, I want to my business. Now what do I do? You
I'm
don't,
so I it's my most
you don't-
disheartening conversation I have on a weekly basis with people. It's like you don't have enough time.
yeah, you don't want to wait. Now's the time.
Well,
Hopefully folks your age that are doing this. And we've had people say, "Oh, I don't need to do that yet. I'm not thinking about selling my business." And I look at them and I say, "Wrong answer."
just point blank, wrong.
Wrong
Try
answer.
again. Well, and in I don't want to take us too much on a tangent, but I think it's a relevant comment here is that this is what why I have an issue with the words exit planning, because someone waits till the year that they want to sell, and it's like, well, you missed an opportunity of the 18 months it takes to hire the executive recruiter, find the president, put the comp plan in place, roll the strategic plan. I mean, like it takes time to invest in the things
Oh,
that grow the value of the company. And
yeah.
Pat, like, I mean,
Think how much better it is if you had 10 years to get to the valuation you want as opposed to 10 months.
right? And I don't know of any private equity firm that does exit planning. No, they build assets and they trade them when the value is correct. And
Right.
and again, I think that there's a place to help people understand that. But that's why I think, just to put a big exclamation point behind what you said, is this is about growing an asset that gives you the choices that you want long term. And then if you're doing what you're saying, by normalizing the EBITDA and tracking that, you could figure out, how do I want to invest my dollars to de-risk my cash flow,
Hmm.
right? I mean, like otherwise you have no guidance. I mean, how have you go for it?
No, go tell because you tell it better than I do. The story about, we had a client who thought his company was worth X, and his
Oh,
his CPA or whoever saying, "Oh, you're in great shape," and then he comes out to find it's worth a third of the X. Why don't you tell that
yeah,
story?
that's all that. And then it's actually going to lean into the next couple topics about like understand what goes into your actual bank account. But like, this gentleman that went through our training with you and I, his wealth manager, which I covered in the last series where we were talking about, don't put the enterprise value, like the purchase price. That wealth manager said, I think it's worth $7 million. He was doing like 15 million in revenue, 1.1 in EBITDA or something like that. It's like 50 to 70 employees. And it's like, no, it's not worth $7 million. The actual value is 5.5, pay some taxes, pay some debt, and he walks away with 2.5. She's $500,000 or $5 million short almost.
Yeah.
It's like, geez. And at that point, he was in his mid 60s or something. So like, how much in like what breaks my heart is when it's the people that don't have energy to get the reward that they deserve for all that hard work. And it's
Right.
like, because by the time they say I want out, and it's like, to get the valuation you want, you're going to have to burn, like reinvest your cash flow for the next 4 years to hopefully get
Or
it.
some health event occurs, and you just can't, you can't do it. Find out today what it's worth, regardless of where you are mentally thinking about selling. Even if you're thinking that's not even on the table, that's fine. It's a good feeling. Of course, I got to be careful here in June of 2022. But to watch your stock portfolio, your assets go up, or your home value to go up, or I mean, that's a cool feeling to watch the value of that. You want to do the same with your ownership in the business. You want to watch that value go up and be on a path that will get you to the point where you have choices to do with your ownership what you want to do.
And you
But
and
you
I,
don't know that in the absence of information. It's just
well, and I think you and I, we honed in on something when we did the story brand material on Arkona a couple years ago. Where like there's this the innate anxiety and frustration for the lack of, I'm gonna let you say it, the lack of what most people are feeling. Progress. Sorry, I know I'm not
progress.
trying to
I'm
not
sorry.
trying to do it to you,
I was
not trying
thinking
to put
about
you on the spot.
you do that all the time to me. I never know what you're going to say.
But it's a lack of progress, and I think you and I
Yeah,
identified that lack of progress is because people don't know why they're doing what they're doing. Like you're spending
right.
all this time, money, and energy, and you have zero idea whether it's growing
Well,
value or not.
and if you don't understand what the value of your company is or what it's going to be, how do you know if you're making progress?
It's ridiculous.
You come and work hard, and that's work. And then is that manifesting itself in your ownership? That's one of the missing pieces that I think causes business owners the most anxiety.
Amen to that.
I
And
had, I had a client once who, but before I met you, who's like, if you could help me sell my business and get $15 million, then sell it. And I'm like, no, because it's worth a whole lot more than that. He didn't even know. I mean, he
like significantly more than that.
significantly more. I mean, so you, in order to measure progress, you have to know what the value is. I
And
mean, you
before
can
we
do that on an ongoing basis.
well, and before we even move on to the enterprise equity net proceeds, is the people you and I did an episode. I don't know if it was a year or two ago about the fact that most people don't even pick up the phone or the email about out of the blue offers.
Right.
And why is that?
Well, because they won't know what to say. If somebody offers me $3 million for my company or $5 million, is that a good deal? Is that a bad deal? I didn't even know the language to talk to them,
Mm-hmm.
what language to use to talk to them. So they just avoid that.
Mm-hmm.
I mean, can you imagine if somebody called and said, "Hey, I'm interested in buying your business"? They like, of course, you get an NDA, but you're like, okay, here's my normalized EBITDA. Here's the multiple for my size, and my cash flow is really sustainable, predictable, and transferable. Here's why. And I won't,
I want to take $1 under
X. You've just leveled the playing field. I mean, you're
well,
now talking the language of private equity and all
mm-hmm.
these other situations, and those are the ones that have the advantage
And you tell a
for the
story
moment.
for the moment. Well, it's funny because like there's $2 trillion of dry powder from private equity firms that are trying to buy good companies. And I always say that the companies with the cash flow actually have the prize and the private equity firms are chasing the prize. So
Yeah.
like acknowledge the fact that you have the upper hand, especially if you have got this kind of language. But also as we talk, you tell this story about when you were running one of the businesses, you bought a company and you
Mhm.
paid the gentleman. He was so happy. You paid him about a third
Oh,
of what the company was worth. And he told probably everyone he crushed it.
yeah. I mean, we bought a company, and like you said, we paid the gentleman to the nickel what he asked for, and it was worth about a third. Uh, it wasn't my job to tell him it was worth more. I worked
You
for
didn't do the
the.
normalized EBITDA and say, hey, by the way, here's the next one.
No, I just said, is this number right? Do I have this number right? Yeah. Okay.
I'll get you a DocuSign in
We'll
like
get your
4
purchase
minutes.
agreement. Hold on a minute. Purchase agreement.
So,
But it's a little bit sad. I don't want that to
right.
happen to people. We certainly don't want it to happen to our clients, but um, it's not some big mystery. I mean, it seems like this whole nother world. Now, I'm not minimizing the complexity of valuations. That world for transactions, for ESOPs, for
Hmm.
publicly traded companies. Look, it's some of the people I respect most in the world live in the
Hmm.
valuation world. They super smart, and it can be complicated, but you can if you it, when you're just trying to put that stake in the ground, there's a way to do it that's not overly burdensome. It's not burdensome at all, and provides enough clarity. Say, okay, here's within this range. Here's where I am today, and I want to be within this range in X amount of time.
And I think
Then it
it's,
gets to the value growth, which is a whole nother topic. But then you can, if you know where you are and where you want to go, you can then set upon developing strategies to get there.
well said. I want to expand
Thank you.
upon you're welcome. If it wasn't well said, I'll just cut it. No, I'm just kidding. So it is complicated, but when you get to the transaction, because there's people, purposes of the deal, like all of that stuff that comes to the table. But I think to just re-emphasize is you or anybody should be able to dig their heels in based on the story that they're telling about the risk of their cash flow, and they should be able to yield that valuation because they engineered a company with that kind of cash flow. Then all the other stuff becomes true noise and complexity, but you have the option to say no if you don't like things that present themselves.
Yeah. If you arm yourself with this information, you make it a whole lot less complex when you get to the actual transaction.
So,
It really is. You can just say, here it is, and let me explain this to you one more time.
so tell the story about how you like to negotiate, of what the buyer said when.
Well, had a client. I worked at a company, and it's okay. Our partner Matt worked there as well, and somebody wanted to buy us, and so we gave them a number, and we didn't move off it. We knew exactly what we wanted. We knew I said, "Here's the synergies. Here's the normalized EBITDA. Here's the mold." I mean, and they kept trying to negotiate, and we're like, we were an ESOP, loved it, and we didn't move a nickel, and they ended up paying it. But in the end, they said, "You guys have an interesting way of negotiating." I said, "How's that?" And he's like, "You don't." I'm like, "Well, we know what we want. We know the numbers. We had done the homework.
Hmm.
But we were an ESOP, so we were doing valuation work. We were coming up with that intrinsic value every single year. I mean, we hadn't been an ESOP but for a couple of years, but we knew what that company was worth in an intrinsic value way. They were laying on their needs to it,
Hmm.
which enabled us to get a premium. But that's a kind of a
And
story
and
for a different.
we'll be diving into that in the next couple episodes. But now I want to go back to that story that I told about. It was 7 million. It was actually 5 million on his personal financial statement, and that is what enterprise value is. So however you want to take it, but there's the
Yeah.
three layers, and then we'll
Yeah.
unpack it.
So normalized EBITDA, which we talked about, times a multiple based on industry, size, risk, all those kinds of things. When you multiply those together and you get value, and we call that enterprise value. So that is the top line, what a purchase price would be, those kinds of things. If you think about your house, that's what the market value of your house would be. Call that enterprise value. Simply the normalized EBITDA times a multiple. And that's where somebody will say, oh, my business is worth $8 million. Well, it could be, and they could be talking about enterprise value.
So technically,
And
they're factually right?
could be, and but they're making a mistake if they put that on their personal financial statement,
Why is that?
because from enterprise value you go to equity value, just much like your house. It goes from what the market says your house is worth. Your house may be worth $400,000 on the market, but if you owe $300,000, your equity value in your house is $100,000. Same with a business. if your business is worth $8 million, but you have debt of 6 million, I'm making up a big number
Hmm.
probably. The equity value of your business is only $2 million. Not only, I'm not minimizing $2
Hmm.
million, but it's certainly not eight. So if you put 8 million on your financial statements, you sure as heck better have the $6 million of the company's debt on your financial statements and your financial statement as well. Or your in our we had a client that had that when he had the 7 million on there, it was overstated by about almost three times of what.
Which it's so common. It's so common. It's it's so common that people almost sometimes don't believe us. That it's like,
Yeah.
no, this is truly just how math works and how valuations work. And I just got to tell the story because it was so absurd. It was years ago, and there was a home service company, and this owner said to me, and I remember looking at your face when I told you this story, and I said the owner said to me that, well, that's fine, but I don't have to pay taxes if I'm over 55. Your face was about the way it is right now. Like, oh, that then just keep it till you're over the 50, 56, man. Then the $4 million just magically disappears.
Yeah, it's just it's not that complicated, but people have so many wrong impressions. So enterprise normalized EBITDA times a multiple, $8 million. Let's just stick with that example. You have debt of six. You get to keep your cash if you were to sell your business. The goal is to come up with a number that would go in your bank account if you were to sell your business today. Because top line number, I don't care if your house is worth $1 million. If you owe $990,000 on it and you sold it, you wouldn't even get the $10,000 because you probably have costs related to it. But the enterprise value minus the debt, you do get to keep the cash. If you have cash in the company, call that net debt, gets you to equity value. Let's follow through our example. 8 million minus the 6 million of debt is $2 million of equity value. If you were to sell your business today, you're going to have to pay taxes on the gain of your sale. So let's just make up a number and say that's $500,000. You subtract that from your equity value. You may have some costs related to, doing the
Lawyers
transaction
and
as well, lawyers and
CPAs
all
and
that. But let's just assume all that's captured in that $500,000. Now you're at $1.5 million. Not making light of $1.5 million, but it's not eight.
right.
And
And
if by
that
chance you have two or three partners and that gets split, now it's less. So the idea, and those are called net proceeds. After everything's said and done, what would go in my bank account today if I were to sell it, even if I'm not thinking about selling it? Because you could have built a company that has a tremendous amount of enterprise value, but it's taken a huge amount of debt to get there. So your equity value is not where it should be. And you need to know that. So you need to go through what's called this waterfall
mhm.
to get to net proceeds, which is an estimate of what would go in your bank account today if you sold it. Go ahead.
Well, I was just going to say, and just to kind of cover some more ground, is the reason that people should measure and monitor the intrinsic value based on the cash flow is because they're not banking on some hypothetical strategic buy. It's just based on in between the white lines of things that are relatively within everybody's control. You can measure, monitor all the things that you talked about on a monthly basis. So maybe kind of shed some light of like, if someone's got a CFO like what you've been doing for our clients and our team does, but anybody, again, you don't need to use us or anybody. Like this is all possible on a monthly basis. So how do you get that visibility of the enterprise equity and net proceeds on any regular basis without doing a deal?
Oh yeah, you just build it right into your financial statement package every month, where you're taking trailing 12 months, which is it takes out all the fluctuations of the past year, apply the adjustments to get to normalize, do the reported EBITDA calculation, list the adjustments, get to normalized EBITDA, put the range of multiples 4 to 6, do the math, and then
Math.
do the math. It's simple math. Then you can subtract. You can add your cash, subtract out your debt to get equity value, and then assume a tax rate and a cost of doing the transaction, and then you get to net proceeds. It's literally can be part of your financial reporting package every month, and then after you do this for a long period of time, you can even go back and see where it was, in previous years. But going forward, then you can just graph and see what's my net proceeds estimate doing over time. Is it going up? Is it going down? Is it staying the same? Am I getting close to achieving my goal? Am I not? And it's not hard to do. It's just you got to have clean financials, and then you got to understand these concepts, and just do the math.
And I would suggest for people listening in on the Arkona website, on the homepage where we have the 5 videos and the 5 principles. In principle 4, Pat and I actually have a little bit of a video that we show of like kind of what this looks like. I mean, and then going back to like, what does this mean and how do people's actions change when they have this information? So maybe kind of just, I don't know if you have any stories in particular, but like, how do things
Uh,
change once you have this?
it is. I don't want to overstate it. It's very enlightening. Like most people think their company's worth more than it is. And even on an enterprise value basis, certainly on a net proceeds basis, they haven't thought through all the adjustments to get through the waterfall to get from enterprise to net proceeds. And sometimes it can be kind of a little bit of a shock. Like, you're kidding me, really?
Mm-hmm.
And we had that a little bit we've had that with clients. They think it's worth,
Most
7,
people,
and
right?
it's actually what would go in their bank accounts 2.5. In an odd way, after the shock, it's very enlightening, and it's very empowering to say, okay, here's where I am, and I want to get here. Then the next step is, what strategies do we develop and implement to get us there? But it can also say, hey, I'm pretty close to where I want to be. Then my options are, I could do an ESOP, I could transfer, sell it to my management team, or things like that on a financial multiple basis. Or somebody could say, hey, I need to squeeze every last nickel out of this when I sell it in 15 years or 10 years or whatever
Mm-hmm.
the number is. So I'm going to develop strategies to do that,
Mm-hmm.
knowing that that's going to be my option. It's not for us to judge, but when they get some insight into this, it then kind of frees them up to think about the other things, the strategies and the business and those kind of things to help them get to the point where they do have choices
Mm-hmm.
and achieve what it is they want to achieve.
So, as we're rounding close to home here, I think about like the intrinsic financial value, and like what to your words, it was so empowering and enlightening years ago when that hit home for me. And this is all within the control of the people that own the companies that are listening into the show right now. And like when it for some reason when it hit me, Pat, and I don't know if this is just how I think, but it was about like the reason that intrinsic financial value is based on the risk of the cash flow has a lot to do with how the company is going to pay for the purchase to someone else, right? Because it's a lot
Mhm.
to do with the ability for that cash flow to service the debt for that next
Sure.
person. So you want to maybe kind of explain why that like why that would work for some like going that $8 million valuation, like why that would work out based on just here's my point of this is that the owners that are listening in that focus on the intrinsic financial value, you can almost guarantee your company's gonna be worth it because it's proving that the story that can be the cash flow can service the purchase price that everybody's discussing.
Right. Yeah, I mean, some buyer who's going to analyze buying your company, they're going to build this into their model like we do with our clients when we're buying companies, and just project out future years of cash flow. What kind of return am I going to get on this investment if I pay X million dollars for it? And you model it out through the 3 statements like we've talked about before, and you come up with the internal rate of return. And they're like, okay, this thing will pay for itself, and I'll make money over the next 5 years or
But a
whatever.
third party buyer is doing that with their infrastructure and their stuff, right? Not
Yeah,
the
sometimes, but sometimes they may analyze it just on the target, just on the company they're
Mhm.
buying.
Mhm.
Will it pay for itself? If the buyer can bring something to the table, cross sell products, those kind of things, that's just kind of gravy on top of it. But somebody's going to look at and say, based on the intrinsic value, will this, if I buy this, will it pay for itself
Mhm.
over a period, 5, 6, 7 years, whatever period of time it is? And that's how people are looking at it. And so the cash flow, the sustainability of it, and the predictability and the transferability is what's key to some buyer thinking, okay, this is a good deal. I can do this because I can enhance the operations. I can, do whatever other things they want to do with it if it's a strategic.
And it's about when you say pay for itself, it's the ability to service the debt, right? Because
Hmm.
it's so interesting too because like if someone like in that $8 million, let's say that person thought their company was worth 12 million, I mean, you could literally just run a math equation and say it can't pay for itself,
Yeah.
right? Like
Yeah.
the SBA loan won't lend too much, or it would be too high of monthly payments, and it's just the numbers don't work.
Oh, and I've working with clients who are trying to buy companies, and the seller wants a double what it's worth. Sometimes I've shown them the model. I'm like, this will not pay for itself. I mean, this thing will not cash flow. So why would we do that? Just because you think it's worth 20x or whatever. We really had one recently that thought they were worth, for a nanosecond, thought they were worth 20x.
Oh boy. So fundamentals, that word hopefully will mean a lot more in the coming year and years. So to kind of wrap up, because we've got other themes that you and I are going to be kicking off throughout the rest of the year. We're going to be talking about how to grow value, de-risk. So we're going to get into a lot more of this meat, but you and I talk about the 3 things that people can do today with their business. You want to just take it, because I love how succinct these 3 items are.
Yeah. You can increase your normalized EBITDA, increase the multiple, and pay down debt. When you do all those things, some of them increase enterprise value that waterfalls down to net proceeds. Some of them influence equity value, which also it falls down and influences net proceeds. Focusing on those things will help you to maximize all 3: the enterprise value, the equity value, and the net proceeds of your business, which is really what you're trying to get to. You want to maximize what would go in your pocket.
Mm-hmm.
On a transaction, and that's what the real measure is.
When I did that panel with the private equity firm that just dropped those 3 things, and he's like, Ryan, is what we do is not that complicated. We increase EBITDA, increase multiple, we pay down debt, and we make a bunch of money doing it. And he was so animated. I was like, you can just tell he was spewing truth out of his mouth.
That's what every private equity in the firm in the country does. That's what we did at ours.
So I would just say, like, for you and I's discussion here, for the listeners, you and I have created this intentional growth financial assessment that's got the foundation of the financials and 4 components. And I would just suggest everybody go take that. They don't need their financials. And on the results page, there's a couple videos. I don't know if you want to maybe describe what we show in the couple videos, or if you remember, if I just forced you to do a video.
You're the one that does all the videos, but we try and show what good looks like. And there's just some foundational things that you need to have in place in order for what we talked about today. You have to have good financials, good monthly financials, and you have to understand these things. So taking that financial assessment, finding out where it is, sometimes people think, oh, the accounting and finance function is, it's just kind of a pain. It just pays the bills. When you're a business owner and you start thinking about your business as an asset, and your goal is to grow the value of that asset, having good, clean financials that are accurate, timely, and useful is essential. And you can't short circuit that. And if you invest in that, then it'll literally pay itself, pay dividends on it.
And I think about, like, the dynamic that you and I have had with Arkona, and then we watch a lot of our clients with themselves and the CFO. It's like the visionary and then the financial reality behind it. It's like being able to see how the impact of your ideas are. And, you and I have, how many times we say, like, the language of business is the financials, and every business owner you and I know can tell a really good story about the history of the company, where it could go. And then the next question is, prove it. Someone's got to be able to prove it.
The financials would tell the story of the business. It's a part of the story of the business.
Well, all right, Mr. Hobby, thank you so much for coming on. do you want to do even where to get in touch with you? Like, do you have a TikTok account, a Snapchat account?
I'm all over social media. As you know.
All right. Well, thank you so much for coming back on the show.